One of the most fundamental things in this course is to establish a framework to assess the cost of capital. Much of the course is devoted towards exploring the different ways that we can do that and to come up with a consistent framework for evaluating hurdle rates for investments in many different countries. Now, it's true that even within the US, there's considerable disagreement over how to get the cost of capital. There are some that would propose the capital asset pricing model. Some would propose a multi-risk version of the capital asset pricing model. Some might suggest an arbitrage pricing theory approach, and there are even other approaches. But there's one very significant difference between the type of disagreement that we've got within the US and the type of difference that we have internationally. I guess it's best to illustrate with example. For one company, the CAPM might suggest that the hurdle rate or the cost of capital for equity is 14%. The multi-beta CAPM might say 15%. The arbitrage pricing theory might say 16. There's disagreement. 14 is not 16. But the range of disagreement is fairly limited. And you would hope if you're doing a project evaluation that if you discount it at 14% and you get a positive net present value, that when you go to 16, you would also get a positive net present value. When we go to the international arena, it's a completely different story. We're talking about very sizable disagreements on what the cost of capital actually is. It could be the case that a major consulting house is telling you that the cost of capital for an average project within this country is 3%, less than the Treasury bill rate. Another major investment bank might suggest that the cost of capital for an average project within this country is 45%. So we're not talking 14 to 16 here. We're talking 3 to 45. And if your project is profitable at 3% discount rate, it's extremely unlikely it's still profitable with a 45% discount rate. So there is massive disagreement as to what model to use in the international arena. And what we will do is to go through these models, point out the strengths and weaknesses of each of the models, and try to come to some convergence as to how to handle the discounting of the cash flows in international markets.